Property taxes and supplemental taxes. Which bills do you have to pay? Which one does the lender pay? I want to explain the difference between property tax bills, supplemental property tax bills, and some things that you should look out for. So, a lot of people are asking me questions about this right now because a lot of people are getting property tax bills in their mail right now. So, if you bought a house this past year, you may have a letter in the mail that has your property tax bill in it, and you might get another letter that has your supplemental tax bill in it. If you have an escrow or impound account set up with your lender, they are collecting taxes and insurance in your mortgage payments to make those payments as they come due. Now, the property tax bill is going to be the property tax bill that was based off of your seller's purchase price. And that purchase price is likely different than what your purchase price is. So they send you a different bill, which is your supplemental tax bill. And that is the gap between the seller's value and your value based on your purchase price. So that amount is something that you have to pay. And that bill is not sent to your lender. You can reach out to your lender's escrow department and ask them if they have enough money in their account to pay that supplemental bill. They might be able to do it and they might not. But it's important for you to know that you need to pay the supplemental tax bill, and you need to be the one to give it to your lender if you want your lender to pay for it for you, or even to request it if they will. And something to look out for that's really important, and I highly advise that you pay attention to this part, is if you're the lender, you're getting that property tax bill that is based on the seller's price, but you're collecting enough that you should be collecting based on the purchase price. That's how they calculated it in the beginning. And so they pay this property tax bill that's likely lower because it's based on the seller's purchase price. And then they do an escrow analysis, as they're required to do every year. And so when they do that escrow analysis, they see that, oh, we have all this money, but we paid this lower amount of money. So we actually have a surplus. So we need to give the client a check, and we need to lower their mortgage payment so we're not over collecting. And so they send you a check, and the client is like, woo, this is great. And they use the money for something, and they continue on doing that. And then what happens is the county finally gets to reassessing your property tax bill that the lender is going to see, and it's a larger bill. And then the lender does their escrow analysis and says, oh no, we have a shortage, and it may be thousands of dollars, and so we're going to need to increase your mortgage payment, and we're going to need to have you pay this shortage. So you can either pay it all at once, or we can stretch it across 12 mortgage payments. We'll add the shortage as well as the deficit in the amount that we should be collecting for the property taxes all of this time. So my advice to my clients is, if you get that shortage check, keep it, bank it, because you may get a shortage later on. So just be aware of that. Be prepared that you may come up with a shortage and you may need to pay it as well. And there's no way out of it. It's property taxes. The county's going to get their property taxes, so you will have to pay those. If you have any questions, please reach out to me. I'd love to help you. And that's all.